Seymour E. and Ruth B. Harris Lecture, which was established in 1975 to reflect the Harris's desire to recognize and celebrate public service. Seymour Harris was an economist who taught at Harvard for more than 40 years and advised both John Kennedy, was established in 1975, among other public roles. The Harris's desire past to recognize and celebrate public Canadian service. Prime Minister Seymour Harris was an economist. The Harris's desire past to recognize and celebrate honored Canadian Prime Minister Seymour Harris as the 2020 Harris Lecturer. Mary Daly is the President and CEO of the Federal Reserve Bank of San Francisco. Harris's desire past to recognize and celebrate honored Canadian Prime Minister Seymour Harris as the 2020 Harris Lecturer. To promote. Mary Daly is the President and CEO of the Federal Reserve Bank of San Francisco. Harris's desire past to recognize and honored Canadian Prime Minister Seymour Harris as the 2020 Harris Lecturer. To promote. Mary Daly is the President and CEO of the Federal Reserve Bank of San Francisco. Harris's desire past to recognize and honored Canadian Prime Minister Seymour Harris as the 2020 Harris Lecturer in Public Affairs. Mary Daly is the President and CEO of the Federal Reserve Bank of San Francisco. Harris's desire past to recognize and honored Canadian Prime Minister Seymour Harris as the 2020 Harris Lecturer in Public Affairs. Mary Daly is the President and CEO of the Federal Reserve Bank and generous friend. So I'm especially pleased that she has agreed to join us today to talk about the U.S. economy and the role of monetary policy in creating a better and more inclusive economic future. This lecture will actually take the form of a conversation. I will ask Mary some questions on my mind, and now I will invite audience members to ask the questions on your minds. So without further ado, please join me in welcoming our very distinguished guest, Federal Reserve Bank President, Mary Daly.
Thank you. Thank you.
Mary, we'll talk mostly today about economic policy, but I'd like to begin by asking a little about you. Most presidents of Federal Reserve banks have been business people or economists focused on overall economic measures and on the financial system. And most Federal Reserve Bank presidents have been men. You don't fit those molds. You are a woman whose research focused initially on the employment of people with disabilities and disability policy, and then on inequality, race, happiness, and other topics. So my first question is, in your early professional life, did you think you might be a Federal Reserve Bank president someday? And as part of that question, how did you think about charting your career path? And what lessons might you draw from your career for the students who have joined us today?
Well, thank you for that question. And to give you an answer to the million-dollar question, when I was first starting out, did I think I'd be a Federal Reserve Bank president? The answer is absolutely not. In fact, it was when I finished my PhD and I'm going on the job market. Now I've been studying labor market issues and social policy, fiscal policy. And I tell them that I'm interested in working at the Federal Reserve Bank of San Francisco, where you study macroeconomics and monetary policy. And my dissertation advisory group was both, I don't think horrified is the right word, but surprised, mildly surprised that I would choose this, and not so optimistic that I would actually have the opportunity. And so I got it, and I was interested in doing really important research, bringing that to a place where I thought, we serve a community of people, and it would be interesting there to have voice in that. And over time, it's something solidified for me that I knew, but I didn't really know, which is that, institutions change people, but people change institutions. And there were many of us, I wasn't the only one, studying microeconomics, fiscal policy, bringing some of the lessons we learned from that work, that research, to bear on monetary policy making. And so while I only became president in October of 2018, I feel like every step of the way, as I practiced my craft as a researcher, as a labor economist, as a person who did public finance and fiscal policy, I was preparing for the very role I have today. Because ultimately, we make the best policy, whether we're on the fiscal or the monetary side of the house, when we understand the tools and techniques of all of us. And this is, I think, especially relevant to maybe many listeners right now, because in a pandemic like we're having and in a disruption like we're having, the most common question I get asked by young people is, what will this do to my long-term trajectory? And I've always said that a crooked path is probably really everyone's path. When you look back, people don't take these linear paths, very few of us. But it's hard when you're younger to imagine that that's true. And so it is really true. You know, my crooked path was not something, I certainly didn't start in age 20 and decide I wanted to be where I'm at now. But I know that every single piece of that work I did over time prepared me for the role I have today. And you can't know that till you get it, but that's absolutely why I think I was able to get the job. There was a lot of candidates who interviewed. I was able to get it in part because of all the various experiences I have, but it's also why I'm able to do my job and feel that I can contribute, is because I have a range of different experiences that don't look anything like the other members of the committee. And those various lenses together, theirs and mine and others, it helps us build literally the best policy we can. Divergent views and diverse voices make for a better policy.
That's wonderful. Thank you. So another question about you. You are now one of the most important economic policymakers in the country and thereby in the world. So I'm curious how you think about your role. What burdens do you feel? What opportunities do you think you have?
That's a terrific question. And it's one I think about every day. And I think about it every day when I look at the newspaper and I see the pain and suffering of the impact of COVID, of the racial injustice and the societal inequities that we see. And they're outside of textbooks now, right? They're really front and center. We're all feeling them. And the question I ask myself, and this is the burden I feel, isn't, here's what it is. What am I going to do materially in my role as a person, in my community, in the organization I work for, to help change the things I see in my lifetime, right? What am I going to do materially? Because ultimately, the burden I feel is to the American people to do my very best in making monetary policy that supports the economy, achieves our full employment mandate, our price stability mandate. But it goes beyond that. It's to form an inclusive economy, one where it's not just good luck whether you can participate. It's actually a commitment that we all make. I go back to, and I think you will understand what I'm saying here, but I go back to, when I was in first grade, even kindergarten, but I remember first grade, we did the Pledge of Allegiance every morning before we sat down to do our schoolwork. And I remember the phrase justice for all. It was something that I believed in. And what I realized in this point is we haven't delivered it. And so the burden I feel most is justice for all. And that's in the economy, it's in our society, and it's in everything we do. And that's really where I put myself as a policymaker. Ultimately, I'm a public servant, and my job is to serve the public in all its capacities, not simply the narrow lanes for which I have direct tools, but also through my speaking and my commitment in places where I don't necessarily have the tools, but I definitely have the voice.
Thank you. That's the right kind of inspiration for our students as we start this year, and for all of us who can be part of tonight's conversation. Let's talk a little economics. This event is titled An Economic Framework for the Future. And as I read through some of your speeches from the past year, certain aspects of the economy appear prominently. These issues also stand out in recent speeches by Jay Powell, the chairman of the Federal Reserve Board, including his remarks last week about the Fed's crucial review of its monetary policy framework. So I thought I would list the three aspects of the economy that seem most important to me from what you've been saying, and then we can take each one in turn, and you can tell us what implications you draw for the Federal Reserve System and for economic policy makers more generally. Mm-hmm. So on my list, the first item is low inflation, the second is low interest rates, and the third is the large differences in economic circumstances for people of different race, gender, educational attainment, and other characteristics. So let's begin with inflation, which has been below the Federal Reserve's target of 2% nearly continuously for the past dozen years, even though the unemployment rate fell below 4% which is a rate at which almost all economists would have predicted rising inflation. So we've had low inflation despite the happy circumstance of low unemployment. What does this mean for economic policy?
So, yeah, this is, I think you were generous in saying almost all economists. Really, almost every single economist I knew probably predicted that inflation would rise more rapidly than it did. And I was one of them. And you think about, why did we think that? Well, because historically it had been true. We had this really beautiful relationship called the Phillips Curve, and it tells us what you think is true in basic economics, that when the demand for workers outstrips the supply, and so unemployment goes way down and the labor market is tight, wages should rise, and that should then pass through to prices, and prices should rise. And so this nice relationship between unemployment and price inflation, which has been true for decade after decade, should have come through, and it didn't. And so a whole group of researchers were able to write things like, is the Phillips curve dead? No, it's just sleeping, etc. But bottom line is, we found ourselves in a world where unemployment continued to fall. It was very low by historical standards, and inflation was barely budging and not up to our target. And there are several reasons why that's the case. But one of them that's really important is that we've got just a different economy, a different global and national economic landscape than we had in the past. And one of the factors there is that we have slower growth, and that's going to put, slower growth means that we have lower interest rates, less policy space, and the Fed can't be as robustly responsive as it might be if we had, if nominal interest rates were at 4.5% neutral instead of 2.5%. We just have more room, and so we had less room. We had a big financial crisis, and there was some idea that maybe it was just going to take us a while to grow out of that. And now I think we've solidified that inflation, downward pressure on inflation globally, and all countries across the globe are experiencing the same slow growth, low interest rates, low inflation. That's with us. And the Federal Reserve, the central banks, will have to be fighting inflation from below the target as opposed to trying to push it down to the target. And fighting from below becomes a little bit harder than pushing from above, pulling it down from above. We're really good. We're practiced at pulling it down, but because we have a full toolkit, right? We raise interest rates, the economy slows, inflation goes down. It was just much harder. The second part of that, and it's going to spill into some of the things about inclusiveness, the second part of that I'll just touch on here is that, so why would someone like me, a labor economist, I think it's a good question to ask all of us, but I'll answer it for myself, why would I think that unemployment had gotten low enough that it's going to start pushing up inflation? And the reason is that as economists, we tend to think that some of the lack of employment among different groups, and whether it's less educated workers or communities of less experience, that they were structural rather than cyclical. And we were pretty sure from history that before we could ever get them to come back into the labor market, or employers to take a chance on them, that inflation would come up, or people would just compete with a few workers, and that we wouldn't be able to bring large numbers back in. But in point of fact, we were. The labor supply, in technical terms, was much more elastic, much more flexible than any of us imagined. And I think it's proven the point that when you get a labor market that is robust enough, employers take a second look at workers that they've screened out for whatever reason. You don't have the right certificate, you don't have the right this. And employers started taking chances on workers that they would never have taken a chance on before. And what is, I think, the most lasting memory from the expansion for me is when I talked to those employers, they said, and we were surprised, because those are some of the best workers, some of the most loyal workers, and they're working as hard as they possibly can now to maintain those relationships with those workers through a pandemic. So it surprised all of us, but it's a lesson we can't forget.
Yes, and I think we will talk more about inclusiveness in just a moment, but just to pick up on a couple of things you said, I think the last point you finished with, that these employers now want to hang on to these workers, illustrates the lasting consequences of economic policy at a point in time. Right? That very high unemployment has lasting negative consequences, and low unemployment can have lasting positive consequences.
Right. Absolutely. So the way Doug, I'm actually credit you for helping me think about this. I remember Doug was a discussant of a paper of mine on labor quality, and it's a paper with co-authors, and it's on labor quality, the quality of workers, and we were talking about experience, and maybe people only get experience for a short time at the end of an expansion. And Doug said something that I won't be able to repeat it exactly, but to paraphrase it, he said, every time someone works, it's output for our economy and it's experience for them. And so even if it lasts for only a year, it's additional experience for them, but it's importantly output for our country. And then he said, and if they continue if there's this positive hysteresis, as economists like to call it, but if there's this persistence, this stickiness, that once you work, employers want to keep you, well, then that's the real win. And I think that's what the last expansion taught us, that more and more people who hadn't worked in a long time because they hadn't been given those opportunities came in. That increased our potential output, but importantly, it was sticky. And they now have experience, and their employers have experience with them, and that actually creates this virtuous cycle. So it gets us out of the vicious cycle, helps with the virtuous cycle. And if I have hope for why post-COVID we can be better off, it's because some of those sticky relationships were created and can help us build a foundation for the future.
Yeah, thank you. So before we go on, let's finish up one last point, which is you talked about the Fed now trying to push inflation up. So for much of our audience, perhaps, their whole lives have had pretty low inflation, but there was a time when inflation in this country was high. And people would tend to say, look, low inflation is better.
Right.
So why would the Fed try to push inflation up? Why should it just be continuing to push it down indefinitely?
Yeah, no, that's and to be honest with you, I was a labor economist, and of course I'd studied macro and everything. I show up on the doorstep of the Fed, and I said, "Why wouldn't we just move it to zero?" And so they realized probably right then they'd made a mistake. They should have hired a macro economist, but they got me, so here I am. But I had a good, healthy skepticism for why would not zero? And here's what I learned. So I dug in and I studied, and here's what I learned. And I think I'm just reflecting years of research at the FOMC, but also across academia, is that we don't measure inflation perfectly. And so you always need some sort of insurance, right? And so what's wrong with having inflation too low? Well, there's problems with inflation too low. There's problem with inflation too high. So we know what the perils of high inflation are, that the most famous story is the German hyperinflation. And the reason I like to tell that story, even though none of us have experienced it, is here in the United States, is that, literally on one week you're carrying your cash in your, a bag to buy bread. And the next week you have to take a wheelbarrow because the currency had lost so much value because the price of bread had increased so much. So you need 4 or 5 times as much of your dollar to buy the same loaf of bread. Well, that's really bad. That causes all kinds of distortions in the economy, and it's not good. And so getting inflation down to 2% is really healthy. But why not let it drift below 2%? Why are we so uncomfortable with it staying in lower levels? Well, the reason there is because imagine now the other scenario, all the way the opposite perspective. What if you thought today prices were one thing, but next week the same exact thing would cost less? Well, only the things that you absolutely had to have to survive would be the ones you would buy today. Otherwise, you would just delay spending. And so if you get into that cycle, so if you get into a deflationary cycle, everything's getting cheaper every week and nobody buys anything. And you end up in this paradox of thrift where we just don't spend at all. And that stalls the economy out. So you need inflation that's just right, so that you've got just enough to keep everything going and not too much to stall things out. And so through lots of study, we've picked 2, and central banks across the world have picked 2 because it's with mismeasurement and other things. It gives us just the right amount of insurance that we won't get into disinflation and deflation, and not so much inflation that it causes people to feel nervous about the future prices. And so it's a different kind of version of the Goldilocks economy. It's the Goldilocks inflation, right? Just the right amount. And I still think 2 is a really good number, and it prevents us from having too little or too much. And that's why the Fed wants to average around this 2% now, as opposed to have people think that 2% is a ceiling, because we really need it to be 2. We can't be happy with 1.5, because 1.5 doesn't give us enough insurance. We need it to be 2. So if we say negative shocks are going to put us a little bit below, so in expansions we're going to run a little bit above, then we get on average 2. That's just the right amount of insurance to ensure that the economy runs well and that we achieve price stability.
Thank you. So let's build on that. So the second aspect of the economy that you talk a lot about and others in the Federal Reserve System talk about is low interest rates. So the federal funds rate, which is set by the Federal Open Market Committee, is essentially zero today, where it has been for more than half of the past decade. And when you and I were growing up as economists, we had no conception that that might happen. So what is going on and what does it mean for monetary policy?
Sure. And this is really, it's super interesting if you study the financial crisis. And what's been going on for the last decade is the neutral rate of interest across the globe, right? The rate of interest that persists when we're in equilibrium and there's no shocks, positive or negative, on the economy, that has been just falling. But because we had the financial crisis, for many years, we couldn't tell whether the financial crisis was pushing the neutral rate down or if it was falling for structural reasons. And there was big debates, robust debates. Now it's completely agreed upon that the neutral rate of interest is falling, and we can trace it back to things that determine the neutral rate of interest in the long run, right? It's not a short run fluctuation, it's the long run dynamics. So what ultimately determines the neutral rate of interest? Well, supply and demand, the supply of savings and the demand to use those savings for investment and spending. So what's going on? Well, the population across the globe is aging. And when people age, they save more, consume less. And so the savings has risen across the globe. We have literally a glut of savings. So now we have loads of savings, and demand for those savings is out of proportion, in part because the birth cohorts following the older generations are just smaller. So there are fewer people looking to do things in the economy like younger people do. And so we have more savers and fewer investors and spenders, and productivity growth is slower. So whether you think of this as the generation of ideas or just the innovation in new startups and projects, the demand for those savings is falling, in part because of the birth cohorts being smaller, but also in part because productivity growth is slower. And so that just puts downward pressure on the neutral rate of interest across the globe. So why is that problematic? What does it mean for a policymaker? So Doug noted when we were growing up as economists, and for much of our lives working in the Fed, where Doug used to work as well, here's what we had. We had just before, in 2012, roughly, the median of the FOMC participants' estimates of the neutral rate of interest, the nominal neutral rate, was 4.5%. So 4.5%. That's 2% inflation and 2.5 real neutral rate. So 4.5 nominal. Right now, our estimate, the longer run estimate, is 2.5%. That's 2 percentage point reduction. Not because inflation's gone anywhere, but because the neutral rate's gone from 2.5 to 0.5. And the pressure on that neutral rate is still trending down. So if I thought as a policymaker in 2012 or before, a couple decades ago, boy, we get a negative shock on the economy. I have 4.5 percentage points worth of interest rate reductions to take. That's a lot. And we used a lot of them in all the different downturns we had. So that's what we call a lot of policy space. So right now, before we ever start, we're at 2.5. So now we get a negative shock and we have, little more than half the policy space. But that's really a constrained toolkit relative to where we were before. So now what it means is we can't just rely on the funds rate when times get tough. And the financial crisis was one of those experiences where we learned a lot about what other tools we need, and we used them. And I will just share with you, with the study of those tools, which we robustly do, I have this stack ranking, which I think is shared by many, but I will speak for myself. My stack ranking of those tools is the funds rate is our first and foremost instrument. We use it first. It's really well tested. We know how it works. So we use that first. And we did that just with COVID. Reduce the funds rate to near zero. The second thing, though, that's really powerful and remains powerful is forward guidance. It's telling people how long we expect that funds rate to be near zero and what the path of normalizing it would look like. And that's part of why we released this long-run framework statement. It's about the strategy so that people understand, markets, participants, households, businesses, what will we be doing? Transparency is our friend. It helps you help us achieve our goals. And so transparency is our friend. And then, of course, when you used your funds rate, you used forward guidance, you also have what is often called quantitative easing, but it's balance sheet policy. It's expanding our balance sheet to ensure that we can, move rates across the yield curve, if you're following things like the yield curve, but exerting more power on the interest rates than just the funds rate would allow for us. So we still have a robust toolkit, but it's not the same toolkit, and the power of any particular tool isn't what it once was.
And can you add just one more thought on this, which is, what are the implications for fiscal policymakers?
Well, let me say, I gave a speech in Ireland right before the pandemic hit. And actually 2 weeks later, I was moving our teams here to teleworking 2 weeks after returning. And in that speech, I said that the world we face, and it's a world without COVID even, it was the world pre-COVID, right? It was the world of less policy space for monetary policymakers, and we have big problems to solve, including inequities across the globe, climate change, all kinds of things that are going on. We are going to have fiscal policymakers really pick up and participate in that sort of longer run building. And so the role for fiscal policymakers is probably never been stronger than it is right now in my lifetime, because the way out of this, we can't do it alone at the Fed, and the way out of so many of the issues that we're in right now is to build what I like to think of as opportunity infrastructure, basically ensuring that people have opportunities to participate in the economy so that we can get every person here working on behalf of all of us. It's one of our contacts in my community said, we all do better when we all do better. And I think that's really where the fiscal agents can help, is making sure that we all do better by we all do better.
Perfect. That's a wonderful transition to the next point I wanted to raise. And then after this little segment, then we'll go to the questions from others. But the third aspect of the economy that you talk a lot about is the large differences in economic circumstances for people, depending on their educational backgrounds, their gender, their race, other characteristics. What do you see as the role of the Federal Reserve in addressing these differences, especially because the Fed traditionally focuses on overall economic measures?
So there's several things I'd like to say on this point. So let me just start it by saying, one of the problems that we have if we're going to fight all of these things is that, and it's a problem. If the Fed can't fight all these things, it's why we tended to focus on the aggregates. And it's because we have one tool and we already have two mandates, right? We have a full employment mandate and we have a price stability mandate. And we have really one tool, which is interest rate policy. Now, I told you various ways we can manage interest rate policy, but we have interest rate policy. That's what we have. We don't make allocated decisions. We simply make interest rate decisions that help ensure that the economy can achieve its full potential. But we don't determine the potential of the economy in any one time. So it becomes challenging. And people ask the question all the time of me, does it mean we're going outside of our lanes to even speak about these things? But I hold to this commitment as a policymaker that we, as in the Fed, and this is true of anybody, but at the Fed, we have to work with the economy we have, and we have to build towards the economy we want. And when you think about building towards the economy you want, take our full employment mandate. Well, we have to manage full employment to the level it is today, right? I cannot myself make allocated decisions as a Federal Reserve policymaker to improve educational attainment. But I can make sure that we run a robust economy so that everybody has a chance to get into the labor market. But I do think it is our role, and you'll see many Federal Reserve officials speaking about this, to be openly speaking about the costs of not having educational attainment be more equally allocated across populations, because we are leaving talent on the table, and we can point out the costs of that. I have worked myself where I try to quantify this and say, how much faster would we have grown if we had been more equal in our opportunities across racial groups, ethnic groups, geographic groups, where people were born, in the income distribution. All of those things are, if you look at the data, there is no one who can see that and say, no one I've ever spoken to says that can just be random, right? The inequities are too large. And so as a Federal Reserve official, I feel it's important to raise that and put some quantification to it and help everyone understand, the fiscal agents in particular, understand the costs of not running an inclusive economy. It's no longer just about fairness. I think that's an important reason to do it. It's a critical reason to do it, but we are also facing slower growth and ever slower growth unless we run a more inclusive economy.
Thank you very much. I would love to keep talking with you myself, but our promise in the forum is to let members of the audience raise their own questions. So I will call on people. When it's your turn, please identify yourself and please ask a brief question so that we can hear President Daly's answers to as many questions as possible. So the first question is from a student, Luis Esteva, who I'm told is a first-year student at Harvard College and has lived in your backyard.
Hi, yeah. So my name's Luis. I'm a first year from Sonoma, so Bay Area, kind of close. I love to see some Bay Area repping. But anyway, so my question is that with all of this recent massive deficit spending from the central government, with the Fed pumping trillions into the economy, paired with all of that low inflation that you guys were talking about, which kind of reminds me of some things that modern monetary theory has been predicting and some policies it's been advocating. Do you think that we're entering into a new era of economics where governments, central banks can run on these massive levels of debt indefinitely, similarly to how modern monetary theory suggests? Or do you think we're going to see a return to the more conservative fiscal and monetary policy that we're used to once this economic crisis ends?
That's a great question, and thanks, Luis, for it. I appreciate it. It's nice to be asked a question by someone who lives not too far from me. So, yeah, this is a common way people are trying to grapple with: is this modern monetary theory? Is it not modern monetary theory? So, let me not. I'm not a expert in modern monetary theory, but let me not talk about that so much, but to say I think of this as distinct, and importantly, here are the elements of how I think about the issue and what I think is really relevant right now. So the independence of the Federal Reserve being a separate entity making interest rate decisions for the economy, I think is essential. That's what our job is, and we're independent. We're not political. We're not making allocated decisions and then using the interest rate policy to fund those allocated decisions. We're working with the economy we were given and achieving our dual mandate goals as an independent entity. That's a really important feature of our governing structure, and I think that's really critical to how we've been able to fare so well, and other countries across the globe who have this structure have fared well, and that's something I feel is really important. Now, if you go back to the fiscal side, though, and you ask, well, aren't we spending a lot of money? And I was a fiscal hawk. I mean, we grew up in an era where you wanted to keep inflation low, fight it and you weren't really fiscal disciplined. So have I abandoned my principles and now I'm not fiscal disciplined? It's really not about that. It's that you have to make investments to ensure that your country and the people in your country can continue to grow. So COVID gives us this enormous shock that we cannot leave these people behind, right? We have to build a bridge to help shore people up so that when we emerge from the crisis, we're well prepared to continue to grow. And here's the real difference, and I think this is a critical difference we all have to have in mind. Spending is not spending, right? All spending is not made equally. So if we spend to consume and we fund that out of our current money, then that will end up being extraordinarily costly to our country. And generations in the future, maybe yours and certainly the next ones, will suffer from that. But if we spend for productivity, if we spend for opportunity, then we will earn a rate of return on that investment, especially when interest rates are low, because we'll be borrowing when rates are low. We'll be building assets, think roads, bridges, digital infrastructure that allows everyone in our country, not just those who can afford it, to have access to Wi-Fi, reliable internet. Think of education, think of climate resiliency. We really have I'm thinking of climate resiliency right now in California, particularly. I mean, think of all of the things we could be investing in that change the potential output of our country and allow us to pay off those debts easily. But that is a particular kind of spending, and that's where the fiscal agents really have to focus, in my opinion. And I think the discipline that we have in our country between the Federal Reserve being independent, making interest rate policy, and then our fiscal agents who are elected officials making the decisions to spend to build as opposed to spend to consume. That's really why I'm less worried. And of course, eventually we will have to pay these debts. But if we've built the economy we want, we'll be able to afford that. I don't think we can afford not to. I think that's the main thing. We can't afford not to spend now, but we have to spend smart.
Right. Thank you so much. And thank you for highlighting that difference. That's definitely an insight I'll take with me.
Thank you.
Thank you, Luis. Our next question will come from Molly Martinez. Molly, please.
Hi, my name is Molly. I'm a junior at the college. I study history and literature with government, and I'm from Dallas, Texas. And I just wanted to say, President Daly, I loved your report about labor markets and the black-white equity gap. And I loved how you pointed out that in order to help close up this gap is the need for educational attainment. And I think within that, too, the access to personal finance education. I would love to know more kind of about how you see your platform in terms of creating more exposure to the Federal Reserve, as well as like using things like Twitter and stuff to engage with these communities.
Well, I'm trying to get my Twitter followers up, but so that's really a good question. Thank you, Molly, for bringing it. So, Doug asked the question earlier about what can the Federal Reserve do? And I said, we have to think about how we can change this in our lifetime. So I am actively working to use every platform we can, because, one of the things that traditionally I think we could have done better as a Fed, but I certainly, all of us as a profession, as an economics profession, I think it's clear we could have done this better, is we're not very inviting to people. I told this story once. I was walking across campus, not your campus, another campus, and there were huge signs the first week by computer scientists and a variety of other STEM, and saying, please come, please women come, African Americans come here. And they had all kinds of, they were really welcoming, and they wanted those individuals of all types to be in their group. And the same time, economics had nothing. And then, of course, you go to the economics office and they're like, well, take these courses, and if you can pass those, come back and talk to us in your second year. Well, we've lost already, right, to not invite people, not even engage. So that's critical. We need to be more inviting and welcoming. And in order for us to do that, we have to shift, this is my view, we have to shift our mindset from we're doing it for others to we're doing it for ourselves. We are not the profession we could be. We're less than the profession we could be because we're not diverse enough. We're not inclusive enough. And we don't have all the voices. The first thing you learn as a policymaker is policymaking is endogenous to the people who make it. In other words, the people around the table determine what it looks like, determine how many problems you can spot, what those problems are, and what solutions are brought in to solve them. So as an economist, I think it should be part of our mantra that we're looking for as many voices as possible. And that's going to mean not just using Twitter. And I'm doing one soon, an Instagram Live. So you get a sneak peek at my home environment as I do Instagram Live to try to reach communities of all types, not just young people, but all over. And I think that's really important, but it's both inviting them in, inviting everyone in, and then listening, and then thinking about the policies that we need. And I will say one of the proudest moments at the Federal Reserve for me has been our Fed Listens events that we did last year as part of our framework review, when we literally went to every district in the nation and in the Board of Governors, and we had community members come, labor leaders, community advocates, people from communities where we said, we're running a hot economy, how does it feel to you? And he said, one gentleman said, well, let me say that it's always a recession here, so we don't know what you're talking about. And it's eye-opening, right, to be in dialogue. And I think if you look at our framework statement that focuses now only on shortfalls in employment and on ensuring that we can let the economy run an inclusive economy, one that has broad inclusion, those are direct reflections of what we learned from those Fed Listens events. So double down on listening, on engaging, and most important, double underline, if you're thinking about majoring in economics or you're already there and you're wondering why you are, double underline, we are working, I know Doug's committed to this, I'm committed to this, we are working to build a more inclusive and inviting profession, and one that reflects your voices, doesn't just make you reflect ours.
Great. Thank you so much for that awesome insight.
Thank you, Molly. And Mary, could you, before we go to the next questioner, want to say a word here about the new series that you are leading at the San Francisco Fed on the future of work?
Sure.
I think it's both some of this outreach you're describing would also addresses a very important subject in economic policy.
Right. So we started this series, the pandemic, it's this is what happens. People want certainty, by the way, and we all want certainty, right? So the pandemic comes, and now all this places around me in San Francisco are saying that they'll telework forever and that this is the new future. And so we tend to grab it, go from one thing to another. So we started this thing called the new future of work, where we're having conversations. We're bringing in people. The first one we did was a pilot. It worked well, so we're doing several more. But it's a series of conversations. And the first one we brought in Ariana Huffington, and she talked about the importance of mental health and, bringing your whole self to work. We also brought in a woman from GitHub who has mostly a remote workforce, but talks about the importance of collaboration and best ideas. And Nick Bloom, who talks about productivity. We're going to talk about workforce development and skills and what skills you need and what we're trying to do in the future of cities. And does this create, one of the questions we have is, does this create a more inclusive economy? And the answer is, we get to determine that, right? The new future of work, if we don't plan it, could leave us with a much less inclusive economy. But if we actively debate and discuss what the new future should look like, well, then of course it can be more inclusive because we're in control of it. So one of the reasons we're having these conversations, if you will, is to ensure that the future we get is the future we want.
Wonderful, thank you. Our next questioner is Anand Hafez, whose starting picture was of him in the forum physically, which I was glad to see. But Anand, thank you for joining us today.
Thank you so much. President Daly, my question is about the stock market, about the US stock market. So despite the pandemic-related struggles of the US economy, the stock market has had, I think, the fastest recovery in history, about 7 months. And the major stock market indices are hitting record highs. And so a lot of pundits and financial media have pointed to this as evidence that the stock market is sort of disconnected or ignoring the economy. Do you share that same concern?
Well, thank you, Anand. That's a great question. I won't say I haven't heard it before, but I will answer it. But I really appreciate it. I think it's an important question, right? Because the stock market, the way we learn it traditionally in economics or finance is that it's forward-looking and people are putting real money on the table. So we take some signal from that. And I think that's all important. But we also know, and you learned this early on too, is that the stock market's not a perfect signal, right? They're reading things and making bets, and there's all kinds of things that affect that. So I take it as an input, but not as a clarity with our truth with a capital T about things. And so the very thing I'm asking myself is, why does it seem to be a disconnect between what the stock market thinks is the future, right, the near term and the longer term, and what do participants think? Well, the first thing that comes to mind when I think about that is that the stock market's making long bets, right? And they see all the stimulus that both the fiscal side of countries and also the monetary policy, central banks and fiscal agents across the globe are really trying to fight COVID with this two-pronged approach when they can. And the ECB is doing this, the Bank of England's doing this, England and the European Union are doing this with the fiscal side, and the United States is doing this. And so they see those things and they say, okay, we have pretty strong momentum in the US economy, really strong momentum. We have the solid inputs for a strong and robust economy. And we have COVID that's really destroyed where we are right now, but maybe hasn't destroyed the future. And so they're putting bets on that. They're looking past COVID and they're looking at what's going to happen going forward. And we are saying we're providing accommodation. They see fiscal accommodation being provided, and I think they're optimistic. That's going to really be distinct from the current experience that most of us have, which is today. And today, you still, at least if you're in California, you can't shop everywhere you want. I still can't get a haircut. Everything I got is on my own. So, so I got the pandemic haircut, guys, so just don't make fun. But seriously, we are all constrained from really behaving in the way we would like to, and go to the movies, do things like that. And as a consequence, our lived experience is different than the stock market's future-looking bet. So do I think there's some disconnect? There could be, but I also believe that, it's just a different lens that they're looking through. And the job of a policymaker is to look at what we have today and really plan to try to get, I would love it if the economy we can deliver through fiscal and Federal Reserve support is the economy the stock market is betting on. So that's what I'm hoping for.
Thank you so much.
Thank you, Nan. Our next questioner is Alice Zhang. Alice, please.
Hi, can you hear me? Okay, yes. Good. Thank you. Hi, Mary. It's great to see you again. We actually met last February, like in 2019, at Stanford's, the Institute for Economic Policy Research event. I just remember you give a wonderful talk, and it was very memorable, and we went to dinner together. So it's amazing to see you again here at Harvard. So I'm actually a current student now at the HKS school, and Dean Elmendorf is actually my dean, so I'm very honored to be here. So my question is, as the U.S. national policies are getting strongly connected with our international policies, from the Fed's perspective, how should the U.S. build a competitive partnership with China? What kind of recommendations you would have that you can share? Thank you.
So here I'm going to really put on my economist hat, because I think the economist hat really informs me about how I think about relationships across the globe, right? And so as an economist, what you learn and what you know is that trade is good for us, right? We use our comparative advantage and everybody gets bigger and all countries can grow faster. So I think this is true whether you're trading with China, you're trading with Europe. Trade is helpful. The pie grows for everyone. But there's a really important piece that I think economists for many decades missed. So this only works, this whole thing about the pie gets bigger, if there's some redistributive agent that helps ensure that when the pie grows, the losers who were displaced by trade get some remuneration and get integrated back in. And I didn't do trade work myself, but I can tell you that if you read the literature now, there's a general admission that we misestimated the cost of trade, free trade, on so many of the cities and communities and populations that were displaced when we could make things less expensively globally. And so that is a great awakening, really, that we have to have policy that is both allowing us to grow faster and trade with each other, but also recognizing that the winners and losers, the winners have to help the losers so that there's more equality, right? We can't it's not a winner take all mentality. And I think this goes back to some of the basic principles of inclusion we were talking about. It's, we have structural gaps that exist, structural inequities that exist that we definitely have to work on. And we have to make sure we don't create more. Right. I think for a while, the free market mentality we had of free trade's good for everyone, the growing pie, and we just misestimated and I think failed to see how we could leave whole swaths of communities I grew up in left idle because they never were able to rebuild because they didn't get the assistance that they needed to do so. So I think that's where the real issue is. If we need trade that's good for all, not just trade that's good for some. And so trade is good, but it has to be done well. And I think this is something that globally people are awakening to. This isn't just a US issue. This is going on in European. So you can think the other side is to be totally protectionist, but that's not a good outcome either. So it's always the case that the hardest thing to do is likely the best thing to do. So this in the middle where some trade is good, but we have to allocate effectively so that people win from the trade. That's where I think we need to be. And that's true whether we're talking about China or any other part of the globe.
Thank you so much. Thank you. Good to see you. Your hair looks fine, by the way.
Thank you. I can't believe I admitted that on a live stream, but thank you. I appreciate it.
Looks good.
Thank you, Alice. So we're running low on remaining time. So we'll take two more questions. And I'll ask the questioners to be brief, and Mary, if your answers can be fairly brief. Next question is from Priyanka Krishnamurthy. Priyanka, please.
Hi, President Mary. Thank you for your time today. My name is Priyanka. I'm a first-year MPA candidate at the Kennedy School, and I'm from Sri Lanka, but I'm right now based in Philadelphia. So my question is around how the Fed uses its balance sheet and the impact that has on the global financial system. Do you think that the glut of US dollars internationally driven by quantitative easing at times of, financial precariousness could be a destabilizing force internationally on, for example, emerging market economies? Thank you.
Sure. Well, thank you for that question. And so let me be brief. So the short answer is I don't think it has been a destabilizing factor in the global financial system, certainly emerging economies. And we saw this more when we were normalizing our balance sheet or thinking about normalizing in the last expansion. But right now, I think that we are doing what all countries are doing, which is trying to fight COVID. And this is something that is important for us to do to increase our balance sheet like many other countries are doing. And I haven't seen signs of destabilizing any particular country in doing that. We're always thinking about how it affects emerging markets, of course, but we make a policy for our domestic economy. And when our domestic economy thrives, other countries thrive as well. That's been historically what's true.
Thank you.
Thank you, Priyanka. This question was actually submitted through some manner I can't quite tell you, but I will read it. My job is to read it.
You sure you're not writing it?
Oh, no, I'm sure. In fact, it comes from Tony Lodge, whom I don't know, and he says, "Do you see an economic rise in rural America due to the pandemic as workers continue to evacuate the city?"
So I hope you'll come to our next New Future of Work conference, because we're going to talk about how this affects cities and geographies. And the question that I think we have is, could it help us have a more inclusive economy geographically? Because you could imagine there's a rebalancing, that there's not this fixed cost of having people, but now we know we can telework and many more people can telework effectively. We're building all these technologies that allow us to do this remote, discussion, lecture. So I hope that we can get more equality across geographies. I think that would be, it's really good for our people. It's good for the communities in those rural areas. And, I was talking about the rural urban gap right before, again, COVID struck, and it was a prime concern of ours. And so this could help, but more to come. We're going to get in some experts, come to the New Future of Work conference. We'll have that very discussion. I appreciate the question, Tony.
Thank you very much. So I'm sorry that we can't take other questions from our audience and from myself. Mary, I want to thank you so much. I feel very fortunate that you are one of our country's leading economic policymakers, and very grateful for your taking the time to join us today. This has been a true privilege and pleasure for all of us at the Kennedy School and all of us at Harvard. I'm going to turn this over in a moment to Mark Guerin, but can we all first just thank President Mary Daly of the San Francisco Fed for a really wonderful evening in the forum.
Thank you. My pleasure, completely.
And now I will turn this over for some, I think, highlights of future events to the director of the Institute of Politics, my colleague, Mark Guerin.
Well, thank you, Doug, and thank you for your thoughtful moderation. President Daly, we thank you. This was our first forum, this endowed lecture, and it could not have been more appropriate. Our mission is to inspire Harvard students to public service. And certainly your journey and your career gives great evidence to the life of consequence that you have led. And I will forever remember your daily charge to yourself. What am I going to do materially to work for change? We all take inspiration from that. And we thank you most sincerely for your candor and thoughtful questions. My job is a simple one, to thank our audience members, the great questions certainly, and to remind all incoming students to the college and to the Kennedy School that we hope the Institute of Politics this semester will be the place where you'll find engaging conversations like tonight's with President Daly. Tomorrow we kick off our Election 2020 forum, where our senior fellow, Dan Baltz, the senior correspondent for the Washington Post, will be discussing the 2020 election with three outstanding national political reporters from CNN, Abby Phillip, from the New York Times, Alex Burns, and from Axios, Margaret Toloff. Next week on Tuesday, the forum will host Andrew Yang, the presidential aspirant, And on also next week, we welcome our 6 new fellows to the Institute of Politics. So there's lively conversations, as Blake said in his opening remarks. We hope very much that you'll join us. So with that, and with our gratitude to President Daly for tonight's really stimulating conversation, we thank you. Good night and all the best for the semester ahead.
Thanks, everybody.
Thank you.